How's it going, friends and family? My name is Amos, and welcome back to the Dividend Compounders with Cheese channel. Listen, I think there's a lot of lessons to be learned from this portfolio review, so you might want to pay attention. Okay, so who's the person behind the portfolio that we are roasting today? His name is Fernando, and he's 64 years old, and he's a cameraman for various ongoing Netflix productions. I think that's pretty cool. And something else that's cool and fascinating about Fernando is that back in the day, he actually worked on the American Godzilla franchise. That's like the coolest bar story you can tell someone, right? If someone wants to one-up you, you just whip that out of your pocket. Nothing can trump that. So given his age, he's only working part-time because why not? His reasoning is this: he's still able to get up in the mornings and he genuinely enjoys his job. And that's the thing. When it comes to the FIRE movement, I think too many people quit a good paying job for the sake of pressing the I'm out button. I don't want to be here anymore. But my thing is, if your coworkers aren't half bad, the hours that you put in every week, it's doable, like 40 to 50 hours, and your supervisor isn't a tool, why not just stay a little longer, put that butt in a seat so that you can make your portfolio a little bigger? Now, obviously, what I just said, it depends on the person because you might have a unique circumstance in which you need to get out of the workplace as soon as possible. But if you love your job, it doesn't hurt to increase the portfolio contributions from your W-2. You know what I'm saying? Not the worst idea in the world. Something else to take into account with Fernando is that he has no children. Well, at least none that he's aware of. He does not like his family, and he would rather maximize his lifestyle while he's still alive. And yes, this sentence is very important for you to know because his portfolio, it reflects it. So with that out of the way, just do keep in mind, none of this is financial or personal advice. This video and everything, the content, everything on this YouTube channel, it's just for fun, coming from an idiot, myself, that has an MBA. If that sounds good with you, let's move on to his portfolio. Now, what you see on your screen right now is Fernando's individual taxable brokerage account. The total valuation as it stands is $485,000. Simplicity's sake, let's just say $500K. He has 24 positions, and the portfolio's dividend yield is roughly 21%. The annual dividend payout is $106,000. Yes, generated from $485,000, which is pretty mind-blowing. Fernando's portfolio is this way by design and on purpose because he has little faith that the Social Security system will survive another 5 years. He thinks that money's going to dry up anytime soon. So he's putting his retirement into his own hands by creating passive income, dividend investing to fuel his Costco runs on Sunday mornings when everyone likes to block the aisles with their carts because they have no situational awareness. It drives me up a wall. I don't know why people don't understand. There's someone behind you, you're blocking the entrance. Whatever. So the goal of the portfolio, what is he trying to do? And by the way, before you judge Fernando or trash him, you got to keep in mind that he's 64. Total return in CAGR, it's nice, but that's not his goal. And that's why, let me go on to the next sheet. Fernando just wants a reliable and a steady paycheck pouring into his account. And he disclosed to me that he has a Roth IRA that pays more in dividends than his current job at Netflix. So this account, even if it were to go to zero, it really wouldn't matter because of his 401k, his Roth IRA, and his other retirement accounts. So the battlefield tactic here is high yield, and high yield it is. $106,000 in dividends from $480,000 invested. That's just that boggles my mind. And then if we were to take a look at his three biggest heavy hitters for who's doing most of the work for the dividend payout, in first place, it's the Round Hill weekly payer of Palantir, $24,000 in dividends. Second place, you have a Bitcoin options ETF, $14,700. And then you have a YieldMax options ETF of Robinhood at $14,200 in dividends. And what's his strategy? The how? How is he achieving his goal? On a high level, it's a barbell strategy. On one end, it's high yield, risky bets, and on the other, it's slow and steady dividend compounders, such as Verizon at number 13 for dividend contributions. And then there's also Altria, and I think there's also Waste Management somewhere. Oh yeah, at number 20. Now, as a reminder, Fernando's 64 years old. What are my high-level thoughts and opinions on his portfolio? It's not necessarily bad. The portfolio to me just feels confused or a little tipsy from day drinking. On the other side of the argument, I think Fernando's portfolio, it's proof that you don't need $5 or $20 million to retire when you have a 21% dividend yield like he does. But I think the bigger question is, will this portfolio last like the capital of about 500 grand until he croaks? Is it going to go down to 300 grand, 200 grand? The reason why I asked that question is because with some of the YieldMax and Roundhill ETFs, the NAV erosion's a serious thing. Also worth noting, he used to do options, but he does not like the stress associated with it. And that's why he's sticking more and more with dividend payers, although he is invested into some of the more aggressive ones. But nonetheless, no more options. Same with me. I stopped cold turkey in 2019. It's literally a casino, like you're gambling. Sometimes you win big, and sometimes you can lose everything. That's why I don't go anywhere near options anymore. Now, with that said, let's score his portfolio. The first criteria, the asset and strategy fit. Do the positions and holdings make sense for their goal? A super high yield. I would argue it's a B minus, maybe even like a C plus. Because do keep in mind that we're evaluating this portfolio in the context of the stated strategy. Very aggressive high yield payers, a balance of boring and crazy. And that's why I think it's a B minus. I think it makes sense on paper. Although I would argue for his age bracket at 64, going into 65, it skews a little heavy into the high risk, high reward category with his weighting towards Bitcoin. And I'll do a deeper breakdown right after the portfolio scorecard. And then the next metric is the level of risk, ranging from 1 to 10. 10 being just bonkers casino style risk. Number 1 being you're probably investing into a high yield savings account. For Fernando, I think it's an 8 out of 10. Look, his massive dividend payout from $500,000, it's impressive, but it comes at a cost. NAV erosion, dividend cuts, and everything in between. Some of his holdings that aren't even YieldMax, they're dividend cutters. So you got Bitcoin, YieldMax, Roundhill, and then also normal stocks, equities that have cut dividends in the past 5 to 10 years. For a lack of better words, I would say he has the risk tolerance of a 21-year-old. The next criteria is the quality of holdings. How amazing are the individual holdings? Do they have an economic moat? Are they compounders? Are the fundamentals sound? Some of the holdings I love, like Chevron, Altria, Waste Management, and sort of like Verizon, has my seal of approval. But a majority of his positions, dude, I do not like whatsoever. There's quite a few cigar butt high yield payers, as I just alluded to. Not too happy with what I'm seeing. If we jump on over to my commentary sheet, as you can see, the green are the ones that I approve of. The ones that are red, I'm kind of disappointed to see. They're positions that I personally wouldn't want to go near. And then for the positions that I have highlighted in yellow under my ADHD notes column, that includes his positions that have exposure to Bitcoin. And I'll save my tongue. Because when it comes to cryptocurrency, it's very polarizing, right? It's like showering naked versus putting a shower cap on. Me personally, I'm in the camp of showering naked, but whatever floats your boat. Same with cryptocurrency. You either get it or you don't. You think it's all smoke and mirrors, or you see it as the digital gold. Regardless, I think you should go and watch my deep dive on strategy, ticker symbol MSTR at the very least, because we go pretty deep in that video. For the purposes of this video, I don't want to get on my little soapbox, turning me from 5'5" to 5'8" to preach about Bitcoin. So let's talk about why I have these ones highlighted in red. I think on surface level, right, you'll see that they have a dividend yield of like, I'm talking about the top 4 positions. They have dividend yields of like 5, 6, 7, 8, 9%, and it looks juicy, right? But then when you take a look at the financial health of the companies, are the dividends sustainable? Are the dividends growing? And for me, that's where the red flags go waving all around the place, because the payout ratio predicated upon the EPS on a GAAP basis, dude, it's like 100 to 200%. And as a proxy, if you do it by the free cash flow per share, it's also above 100%. Meaning the top 4 companies, in one way or another, they're paying and funding a dividend that they cannot afford to do so with almost all the cash that they have. And that's why the first one, they just cut their dividend, ticker symbol LYB. And then the bottom 3, I think dividend cuts are on the menu. I'm not trying to be a negative Nancy, but based on the numbers, I would make an educated guess if that's what's going to happen. And then also highlighted in yellow, besides his Bitcoin positions, are the ones where I'm just like, whatever. It's like a C. It's neither good or ugly. It's whatever. So when it comes to a whatever, a satisfactory or an average kind of position or a company, for me, I wouldn't want it being anywhere near my portfolio, because I always think about it in the optics of, would I want to buy this business right now and become a share owner of it instead of just looking at it as a ticker symbol? If the answer is not an astounding yes, like why bother, right? And then obviously I'm biased. I'm not a fan of YieldMax or Round Hill. Definitely think they're yield traps, and that's why I have it labeled as such. But the YieldMax ETF that generates a huge fat dividend from the semiconductor space, they're crushing it because they're doing it against names like NVIDIA, AMD, and Broadcom. So that's why I have it labeled as working for now. Who is to say 2 or 3 or 4 years from now it's going to continue working? I feel like the YieldMax strategy is just way too aggressive to be sustainable. That's why my commentary is so negative when it comes to them. But then let's talk about the positives, right? I think some of his positions are really good. For instance, I had never heard of the Reeves Utility Closed-End Fund right there, ticker symbol UTG. Juicy fat dividend yield, and their CAGR for the past 5 years is really good. But also the tailwind of the utility sector right now, they're powering up the data centers. So not only are they a regulated monopoly that prints cash when the times are good or bad, they're also front and center of the data center boom. And as you know, Amazon is spending $200 billion in capital expenditures building out data centers right now in Northern Virginia. Same with Meta, same with Microsoft. And as these data centers are sprouting up left and right all over the country, even in the middle of nowhere, Arkansas, the huge beneficiaries of that are the utilities, which is kind of crazy to see, but they also pay a fat dividend. Really like that one. Waste management, I do like. I really like the waste disposal services because I think that's a buy and hold forever. Trash and making it disappear, like you'll pay money so that it's out of sight, out of mind 2 to 3 times a week. Not only for commercial customers, but residentials as well. Waste management's not my favorite. I would say it's in the top 3 because I would say it's Waste Connections, a Canadian company, and then Republic Services, and then Waste Management. So the first 2 I would say is S tier, Waste Management, A tier. Reason being is that their leadership, I have heard negative things about. Now obviously that's very judgmental, so let's move right along. Verizon is pretty good. I mean, the telecom sector is basically like a utility. Everybody has internet and phone bills, especially in 2026 when everyone lives by their screen. So at Verizon, for me, it's not going to have the greatest growth, or actually they've been kicking butt. For the past 2 to 3 weeks, they're going to the moon. But for the longest time, they were an underperformer. Their dividend profile is very good. I really like Chevron, especially in 2026. Oil and gas, especially with the current administration, they're going to be printing cash, at least for the next 2.5 years. Altria is a really good one. And then CME, I just uploaded a deep dive video on. Love it. And then, of course, BTI, which is a parallel play to Altria, different tobacco products. And then for the last metric, it's predicated upon the dividend sustainability. Healthy, is it okay, manageable, or is it risky? I think for Fernando, I think it's risky with the side of cheese. Because look, his portfolio, it's not SCHD and chill. For most people, you could just dollar cost average into VU and SCHD, and we can also throw in SCHG into that conversation, and you look back in your portfolio 10 to 20 years from now, you'll be a very happy camper roasting marshmallows butt naked in Yosemite. I would argue Fernando's portfolio is the complete opposite of SCHD and chill. I think this is YieldMax and thrill. And I'm going to be honest with you guys, I have a negative association with YieldMax, Roundhill, and all of that because I myself, I'm a YieldMax survivor. I actually invested into them at the end of 2025 and I got burned really badly. And that's why, as I see Fernando having a big position into YieldMax in his portfolio, I feel nervous. I feel nervous for him because the problem is the crystal magic 8 ball, right? It's nearly impossible to forecast whether or not these ultra high yielders of like 50 to 100% dividend yield, if they'll even be around in 5 years. At the rate that their more popular ones are performing with the nonstop NAV erosion, they're just going to continue to do reverse stock splits until everyone jumps ship. And then when there's no more assets under management, I think that's when they'll dry up. But maybe that's a little too negative. Maybe they'll learn from their lesson of having a ridiculously high yield that's not sustainable. But then again, why wait for a turnaround story with YieldMax when there's an ETF fund managers that do exactly what I'm talking about right now? And that's why I'm personally biased towards the NEOS funds. No, you're not going to get an 80% dividend yield. With the NEOS funds, you usually get like an 8, 9, 10, maybe even like a 15, 20% dividend yield. But what you get are manageable yields without the NAV erosion. Or as I like to call it, the slow motion portfolio suicide. Because you're getting money every week or every month, depending on the YieldMax or Roundhill investment vehicle. But then you'll see the capital of that position shrink. So it's like the dividends are coming in, but then the portfolio position is going down. So in the end, you're almost breaking even. Unless, of course, we're talking about YieldMax's semiconductor options ETF. Then you're crushing, but that's one. Which takes me to the next segment of the video. What would I do differently if I had to improve this portfolio as a case study, as a homework assignment? Dude, I'm 35, and let's assume it's homework. But please do keep in mind, this is not financial advice. I have to repeat myself because I don't want someone to be like, hey, why are you saying all of that? I'm just talking to myself because I'm a lunatic. I'm just filming, talking to myself. I'm crazy in the head, okay? If I had to summarize Fernando's portfolio philosophy in one sentence, it's this. I want my investments to pay me enough that I never care what the market does. And I think that's my takeaway from his positions, right? I think that's why he's invested into what he's invested into. But to that, I would say, look, there's a million different ways to generate a synthetic paycheck from dividends. But Fernando's taking the scenic route through a minefield. It's just really a volatile situation where the portfolio, it might work today, sure. But is it still going to be working when Fernando's 70 or when he's 80 or when he's 85? Like just looking down the road, will this still be executing? Now, I'm not trying to judge the man because I think most of us watching this video, we're trying to do the exact same thing that he's doing, right? Building a DIY pension so that we can tell the 9-to-5 life to kick rocks. Like if someone talks to you or looks at you weird in the lunchroom or anything at work, you could be like, you better hold your tongue. I'm about to quit right now. I'm about to put in my 2 weeks notice. Like that's what we all want and fantasize. But there's a massive difference between building a nest egg, being more aggressive with your allocations like Palantir, Broadcom, Nvidia, versus defending what you have built for the past 64 years. At 64, you've already crossed the finish line. You've won the game. You have $500,000 in an individual taxable brokerage account. And then for your Roth IRA, you also have whatever amounts, and your 401k, And the list goes on and on. You've won the game. So why are you still playing like you're down by 20 points in the fourth quarter? Unless you're primetime Tom Brady and the Patriots in a Super Bowl. Then of course you can make a comeback. But like from what I'm seeing, you have enough capital to make it work. So it might be time to stop saying YOLO and throwing Hail Marys every single play. Like the defense is just going to be in a nickelback or a zone coverage and you're not going to be able to get anything. So having said that, this is what I would do if I woke up at 64 years old, my hairline was receding, and this was my situation in my portfolio. Step number one, I would whip out a pen and paper and I would try to figure out my living expenses on a day-to-day, week-to-week, quarter-over-quarter basis. That way I could figure out how much I genuinely need to survive. Groceries, utility, mortgage payments, insurance, everything baked in. And on top of that number, I would bake in 4% for inflation. Usually it's like 2%, 3%, but 4% to give that extra margin of safety. That way you're not under calculating. And then I would adjust my retirement game plan accordingly. Like if it spits out a number of like $20,000, like that's how much I'm spending per year, then I would want my dividend income to be increasing by at least 4% every year to cover my living expenses for the next year. For step two, I would absolutely reduce my exposure to YieldMax and Roundhill to a much smaller allocation if I can't just eliminate it outright. And I would go into very high yield payers that are really good, like the financials are healthy. Number one, like Realty Income Corporation, Universal Corporation. It's kind of like Altria because they're headquartered right next to them in Virginia, also in the tobacco space. Ares Capital or Main Street Capital, two BDCs that I really like, very high quality. Progressive Insurance, Prudential, Target, little icky because their top line is shrinking because of the ramifications of the boycott, but their dividend profile is absolutely healthy, and I don't think Target's going to disappear. I think right now they're going through a little bit of a PR issue, but I think given enough time, I think they'll recover and make a comeback. And then there's also SCHD. I know I talked about it earlier, but for me, it's a non-negotiable. Doesn't matter if you're 30, 40, or even 80 years old. An allocation for SCHD is allowing dividend growth to be baked into your portfolio to protect purchasing power. Because I think the 5-year or 10-year CAGR for their dividend growth rate is like 10%. So to know that the payout is increasing because of SCHD is a good thing. And then I would also have a safer high yield options ETF such as the QQQI, which is the NEOS variety of the NASDAQ 100, or the Goldman Sachs variety GPIQ. Either one is a good option. Me personally, I prefer the Goldman Sachs one if it's just those two. And then also the ETF BIZD, ticker symbol BIZD. I know we talked about Ares Capital, Main Street Capital, but I think BIZD right now, they're at a very historically low valuation because of the pending interest rate cuts, and then also the fear and doom that's happening in the private credit market right now because of the allocation and funding for tech companies and software defaulting because of Anthropic. Some might say it's a death sentence, and others will say it's an opportunity. And then also, very recently, we just covered it on the channel, Hess Midstream. I think they belong in this conversation for high yield dividend payers, especially since I'm 64. And then step 3, this is absolutely subjective because it really depends on the person. Me personally, I would withdraw and pull Social Security the day I am eligible at 62 years old. And yes, I would do that knowing full well that I would receive less per paycheck. Because think about it, 69 or even 71, dude, that's not a guarantee. Even me, tomorrow, my life could end. You could be the healthiest guy at the gym, and you could still get taken out by a distracted driver at 65. So my philosophy, if the government is standing there with a bag of my own money that I contributed every 2 weeks from my W-2 that was deducted to fund Social Security, I'm not waiting for them to change their mind or for the program to restructure itself into oblivion or for politicians to fight over the funding for Social Security. Is it going to stay? Is it going to leave? I would want my cut right now. I would rather take a smaller check in my hand today than a theoretical bigger check at age 68, 69, 70. Because that's a future that I might not get invited to. At 64, 65, while I'm still alive and healthy, give me my paycheck, right? That's not financial advice. It's just what I would do. I'm telling you, when I turn 62, I'm pulling out my Social Security checks as soon as possible because I can use that money to buy into high yield dividend payers and compound my money faster than waiting until I'm like 70, if that makes sense. And then for step 4, as you can see on your screen right now, there's 24 holdings in Fernando's portfolio. This is what I would do. Basically, almost everybody that was highlighted yellow or red, they're gone. And then the ones that are bolded, they're the new additions to the portfolio. The first call out that I have is SCHD. I'm not joking when I say that SCHD is a non-negotiable, and they would be 150 grand out of the 485. That's how strongly I feel about them, especially for a retirement income account. And then I would also have about 51 grand into QQQI, and then about 22 grand into Hess Midstream, and then 16 grand into BizD. And yes, with these changes, the passive income is going to get a drastic haircut. It's going from like a ponytail to a buzz cut. It's much lower. It's dropping from 100 grand annual dividend payout to $62,000. But I would bridge the gap with the Social Security paychecks. And the dividend payout would grow, unlike the original portfolio where there's NAV erosion. Because when that position gets smaller and smaller, the income associated with that YieldMax or Roundhill ETF, it's also going to get smaller year over year. Because what I'm trying to say is if it starts out, IPO's at $20 and it has a really fat high payout, and it keeps dropping down to $10 a share or $5 a share, that payout's not going to be the same as if it were a $10 a share ETF or a $20 a share ETF. That payout gets smaller and smaller. So this portfolio, the modified version, it's doing the complete opposite. Now, even though in the modified portfolio, I basically eliminated all of the Bitcoin associated positions except the Roundhill one right here and the Pro Shares one right there, I want to add some color as to why I'm leaving those two alone. Bitcoin goes through cycles of peaks and valleys. If you pull them up and look at their price history, it's not a smooth and steady ride. It is very volatile. It's a roller coaster start to finish. Every single time that they crash, people tweet out saying it's all over. People start writing blog posts, uploading YouTube videos saying it was all a scam. It's all over. And yet, Bitcoin always finds a way to bounce back. Now, obviously, past performance is not indicative of future gains. Bitcoin could crash to $20,000 a piece. It could crash to $1,000 a piece. It could absolutely do that. But knowing historically that whenever they reach a valley, they bounce on back to reach a new all-time high, to sell out of them while they're heading towards that valley position, it's kind of like, you know what I'm saying? So let's just go ahead and meet in the middle and say the dividend dealers, the safe and steady dividend payers, about 94% of the portfolio. And then 6% is allocated towards Bitcoin. Oh yeah, we have that breakdown right here. So 6.5% of his portfolio's weighting is towards Bitcoin related vehicles. And I really don't like how it's 11%. Personally, I wanted it to be 10%, but 11.2% of the modified portfolio has a relationship with YieldMax or Roundhill, and then 30.8% of the portfolio is allocated towards SCHD. I would argue it should be closer to 40 or 50%. But obviously, if we go in that direction, the annual dividend payout would get reduced in lieu of the dividend growth rate. But at 64, I think it's about balance and prioritizing the income while also pumping a little bit of the growth rate in there, not just NAV erosion and a declining dividend payout. So case in point, because of SCHD and some of the other high-quality compounders in the portfolio, the weighted average dividend growth rate is 4.75%, meaning year one, the payout is $62,000, which is slightly below the median income in the U.S. you might be able to make do, especially because you have a part-time job, plus social security checks, plus a 401k, plus a Roth IRA or TSP or whatever. But because of the dividend growth rate, that payout would increase by 4.7% the next year, and your annual dividend payout would be 64 grand, and then 68 grand, 71 grand, and then 74 grand. It would keep up with the rate of inflation and then some. Having said that, I'm pretty proud of this analysis. I think it's my best work yet in the Roast My Portfolio series. So what do you guys think of Fernando's portfolio? Obviously, this is my modified version, so let me go back to his. Yeah, so do you love it? Do you hate it? Do you think it's a brilliant income machine? Let him know, because he's reading the comments. And other than that, dude, if you can't tell by my outfit and attire, the MLS, the Major League Soccer, which is the level 1, tier 1 soccer here in the US, it kicks off this weekend. And that's exactly what I'm going to be doing Sunday morning here in Japan. Obviously, I'm filming this video right now on Saturday evening. And so by the time you watch this video, I'm sincerely hoping that we win. We walk away with a W. But another game that I'm looking forward to is LAFC versus Inter Miami, because it's Son Heung-min versus Lionel Messi, two superstars. And the reason why I'm able to watch it is because I have an Apple TV account and they live stream every game. And that's why I said that's one reason as to why I'm bullish about Apple is their partnership with the MLS and how soccer is now the number 3 most popular sport in the US. And to watch an MLS game, you got to sign up for Apple TV. Of course, they have other endeavors and stuff that they're pursuing, like the iPhone, the MacBook, Apple Care, the subscription fees, everything. They're doing good, but I'm most bullish about their partnership in the soccer universe. And it's actually one of my side projects right now. I'm making content for all things MLS related. You know, that's the pros and cons of having ADHD. One thing that's nice is life never gets boring for me. I have a million different interests, hobbies, and projects going on. So whenever I meet someone, we can relate on at least 1 or 2 things. That's how vast this head is. Like I'm into so many different things. Right now, before I go to sleep, I read. And I'm rotating among 7 books. After one chapter, I just go to the next book. I can't sit there and just read one book cover to cover like a normal person would. But anyways, it keeps me from burning out because if I only made content for this channel and this account, I feel like I would have writer's block. However, let's be honest, no one cares. So if you made it to this point in the video, I love you. Thanks for hanging out with me. Stay safe, good luck in the stock market, and I will talk to you next time.